And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Concerns about a wider conflict in the Middle East are mixing with the existing concern on sticky inflation. It's creating a very difficult stew for investors. Now, what, if anything, might do well in an uncertain environment like this? Let's talk about the reflation trade with Jan van Eck. He's the CEO of Van Eck, and Mike Akins from ETF Action. Gentlemen, thanks for joining me. Jan, you run a well-known commodity trading firm. This guy has a large suite of ETFs for gold, silver, energy, steel, other commodities. The reflation trade's done great this year. You made the point that global manufacturing is ticking higher. That seems to be the key point. That's driving this reflation trade. Explain what's going on.
Yeah, I think there's some powerful investable trends. Kind of the stuff coming out of the Middle East is hard to predict on a day-to-day basis. But there was a big change that happened in the first quarter, which was that the world economy started growing again. And the best measure I like for that is PMIs. They ticked above 50. And more importantly, China, which had been such a huge driver of growth and so negative for growth over the last year or two, manufacturing PMI is now positive in China as of March, and surprisingly positive. Like, this isn't like a little bit of a statistical move. You now have growth. The world economy is growing, so that leads to your reflation trade.
So that's what's driving commodities. Now, I think we have a chart here, an index of investable commodities is out there. That's the S&P GSCI. I don't know if we can put that up. That's advanced, what, 12, 13, 14% this year, outpacing the S&P 500 up, what, 9%. So copper and oil have had big gains as well, respectively, and that's reflected. Here it is. There you go, John.
Yep.
Look at the move up there. This is a basket of global commodities. That's moving because manufacturing has been improving.
The global PMI is not just manufacturing, it's both services and manufacturing. Yeah. China is just manufacturing because their services is always growing because they're moving from being a manufacturing to a services economy. But no, that's it. It's copper, Dr. Copper, they say that because it's a good measure of global economic growth. And energy prices probably have gotten a little bit ahead of themselves, but they're reflecting the world is growing.
Now, how does higher interest rates play in here? What role does that play in the whole reflation trade? And can that trade still keep going? I mean, I bring this up all the time, and they say, well, that's nice, Bob, but oil's already had a big move this year, for example. Just explain interest rates and how it plays into the mix here.
I think that's a great point because people in America look very short term, I think, and they're really focused on Fed policy. The reason I think that we're seeing growth and inflation in the United States is because, and I missed this for quite a while, is fiscal spending is running so super hot. It's crazy. We're running a 6.5% budget deficit, and that's what's causing inflation. It's the government spending, and I think that's leading to this global growth trade too. So that's why I like commodities, because I think it's more than just a headline. I think these trends are medium term.
Mike, we used to have Goldilocks a while ago. We had a strong economy, we had earnings growth, and inflation was trending down. Now we still have a strong economy, and we still have earnings growth, at least projected for this year, but now we've got this sticky inflation problem. So how does this play into the world you're looking at, the ETF world? How does sticky inflation and the reflation mix with these Middle East concerns, and what are you seeing in terms of flows for ETFs?
Yeah, on a flows basis, we're seeing year to date, it was primarily driven by technology. Growth equities were driving all of the flows across the board. Over the past month, though, we've seen that a little bit reverse, especially across the commodity trades, whether you're looking at like commodity ETFs have turned positive over the past month. Year to date, they're still negative, but they've turned positive. And also, if you look across the equity sectors of the market, energy is the second highest inflower from a ETF perspective, energy ETFs over the past month. They're still negative, barely year to date, but we've seen a big trend coming back into some of those more sensitive commodity-driven sectors of the market. And if you look through it to kind of an industry level, you're seeing that play out in natural resources and some of the exploration and commodity-driven hard asset producers within the sector ETFs. So I think from that perspective, go ahead.
Go ahead, Mike. I'm sorry, finish your point.
I was going to say, well, I think one of the big things that's different now than, say, 3 years ago when we had this kind of inflation crisis is that at that time, the fundamentals for the hard producing commodity sectors were really broken down. You looked at, like, if we rate ETFs on a quality basis, and energy 3 years ago had the worst quality rating out of the 11 GIC sectors. Today it's the second highest quality rating. So I think you've seen over the last 3 years a situation where these energy equity ETFs have really cleaned up their balance sheets. And now if we can see some sort of that growth demand, and you can see an increase in their margins, it's likely to go through to that bottom line, because if you look at the quality metrics and they're still trading at a much lower discount relative to the overall market, it sets up nice for this area of the market.
Mike brings up a very interesting point, because his point here is, just recently have we seen little upticks in energy. When I look at flows on the yearly basis, where the money is going, it's still into technology. Your Van Eck Semi still gets inflows. Energy ETFs have not seen big inflows at all, even with energy up 18% this year. That's amazing to me. Why are investors not showing any love for energy or commodities when that's what's moving? Usually they follow the trend, and they don't seem to be doing that.
Because it's a recent phenomenon. I mean, flows, buyers like higher, right? So only when prices started ticking up, and this news is fresh. That's why I'd like to focus on it. Like this China PMI data, this is only March data. It came out a couple of days ago. And so I think investors are now starting to focus on it. And I think also, yes, the companies are higher quality, meaning they fix their financial situation, but there's still some headwinds. There's a lot of regulation in Africa and Latin America that have been trying to take renegotiate the profit share with some of these producers. So that's favored the United States and Canada. So there's still some internal headwinds with that sector, and it's hard to compete with technology. So investors, I don't think, are really looking at these allocations yet.
Well, what is energy is what? 7% of the S&P 500. What is a sensible weighting to energy stocks in a diversified global portfolio? The investors seem to have no interest in it. It went down as low as 3% a few years ago. It's higher now, maybe it's 6 or 7%. But is there a sensible allocation for people, in your opinion, right now?
Yeah, I mean, we like the 5% range for commodities. I also think you need to have some gold or Bitcoin in your portfolio for what I call the 2025 fiscal reckoning. So I think in 25 we have a lot of fiscal decisions to make in the United States. We can't spend the money that we're spending. We've got Social Security coming up. The Trump tax cuts need to be renegotiated. They come up in 2025. And you've got the two candidates, or the two biggest spenders ever in US history, peacetime spenders. So I think the market is starting to worry about that. That's why gold's rallying so hard.
Mike, do you agree with Jan's point here that the reason we haven't seen much inflows into gold and commodities this year is because the data is still fresh and investors haven't caught up yet, or investors just not interested? Your thoughts on this?
The gold trade is much more about a flight to safety, in my opinion. And when you look at the commodity trade, it's broader based. Like the S&P, GCI, it's much more about the inflation trade and the growth of the economy. So I keep those kind of, in my view, a little bit separated.
So yeah, and I do too. I do too. And so I'm medium bullish on commodities. I'm very bullish on you need some gold or Bitcoin in your portfolio. I've been saving.
Well, you're saying there's a different dynamic.
Yeah,
here.
I'm agreeing with Mike. I'm just following up, and I just say that our conviction on gold and Bitcoin is very high, because you need
and
to
gold
have
is a play on what?
A hedge for that 2025 fiscal problems in the United States. People around the world are buying gold because they think the U.S. government is spending way too much money. Right, it's not even close. We have the huge, largest fiscal deficit in U.S. history in peacetime.
It's a little more than 100%
full employment
of GDP.
This is like the Fed buying mortgage bonds in the middle of the hottest housing market a year or two ago. This is insane. The young people today are going to look back at this 23, 24 era and say, "What were you guys doing, borrowing trillions of dollars with full employment?"
Yeah, it's a tough situation.
And that's
right
what
now.
people are worried about, that we print money to get out of this debt problem, boom, great for gold.